Rather than having 15 different ETFs, mutual funds, and 6 different investing platforms, it's always best to have boring, simple 3 to 4 ETF portfolio, and that is more than enough. If you know how to read balance sheets, do ratio analysis, and have a good understanding on how the market moves, then it's always best to choose a particular company's stock option, which is the best in my opinion. But if you don't have an understanding why this particular company's share is performing better compared to its peers, then ETF is the easiest option. In 2025, you could find hundreds of ETF options. And what I've noticed is some of the ETFs, they have own benchmark index, and which is shocking. In my opinion, due to rapid growth of information flow and all informations are readily available, and sometimes we get overwhelmed with this content and a lot of YouTube channels, and we started consuming a lot of information. There is in fact information overload in our systems, and that we start doing trading, gambling, NFTs, crypto, which is wrong. The simple solution to this is invest in what makes sense to you and not what other people wants you to invest in. So friends, when we look at worldwide stock market trends on the Google, we might get an idea where the market is going. But for a country, foreign investment is key, and therefore countries such as UAE, Singapore, and China are offering very good advantages to their foreign institutional investors. So do you think so that in return, what foreign institutional investors, these are the large investors, are just seeking for security and tax advantages so that they can keep more profit to their pockets, right? Not exactly. FIIs do check certain parameters, and one such parameter is PE ratio, price to earning ratio. So this basically helps them to understand whether the country's particular market is oversaturated or overvalued or not. Now let's understand the basic of PE ratio. So what is PE ratio and why it is important for us as an investor? So just I've make a very simple example so you guys can understand. So formula for PE ratio is market price per share divided by earning per share. Okay, so in order to get earning per share, you need to check the company's profit after tax, and that has to be divided by total number of allotted shares. So let's take an example of any random company in the UK. Let's just to make it very simple, if they are making profit after tax, so this is the pure profit after tax, which is £200,000 per annum, and the allotted shares are 20,000 shares. So that EPS, earning per share, is equivalent to 10. This is just EPS, earning per share. Now when we come back to the actual formula of PE ratio, which is market price per share divided by earnings per share, which is EPS, we just found out. So the market price for that particular share is £100 and the earning per share is 10. So it's 100 divided by 10. So your PE ratio comes to 10. So now you might think that what does that mean? So technically it means that the investor is ready to pay 10 times of the earning of that particular share to the current market price. Even a country's popular index such as S&P 500, even they have their own PE ratio. So when we look at the current PE ratio of S&P 500, which is 23.73, this is as of today, dated 25th of May 2025. So in a nutshell, PE helps us to understand as an investor whether the stock's particular price or the index's particular PE, is it overvalued or not. But technically it is just one of the concepts, but actually it is not always true. We have seen that sometimes PE goes above that particular threshold, and after that the index has performed better compared to whatever the benchmark it is. Although it's really important to understand what is the industry benchmark and different types of ratios. Ratios can help us to guide up to a certain extent, but there are too many parameters which a foreign institutional investor, such as a big company such as UK's pension fund, if they are the large investor, then they have their own systems, and they do understand these kind of ratios. So they do some more research compared to what we are doing as a retail investors. So you might be thinking that what other factors do these FIIs, foreign institutional investors, to consider? So generally speaking, FIIs do consider the country's tax advantages and tax benefits. Countries such as UAE, Singapore, and China, which I've just mentioned, in fact Brazil up to a certain extent, are offering better tax advantages compared to USA and UK, for example. But one important such point which we all small investors, retail investors, do miss out, and these big FIIs don't, and that is negotiation. Yes, guys. So because they are large investors, they have their own tax advantages and negotiations, not only in terms of prices, but also their availability and many tax advantages and tax loopholes, for example, so that they can keep more in return, and eventually they give us less. So generally speaking, individual stock picking and playing this numbers game is not what we as a small investors should focus on, but instead we should focus on just simple, basic, boring S&P 500 kind of ETF, but we should remain invested for at least 25 to 30 years. Why I'm saying is because that we'll understand in the next stage. So please do allow me to show you why it is important for us to invest at least 25 to 30 years. So looking at the current investing trends, USA will face a lot of uncertainties, and which can be reflected by Trump's current policies, and that could be seen from various articles such as this article, and this one. And the cherry on the cake is Moody has downgraded their ratings. You can go to the Moody's ratings website and you can get a full picture. So once you read the full report, then you might get an idea, guys. So this is what they are saying is, we anticipate that the federal debt burden will rise to about 134% of GDP by 2035 compared to 98%, which is 2024. Now this is their debt to GDP ratio. This is what they are talking about, which is going to go up by 134% in 2035. Current debt to GDP is 98%. So you can understand that their internal policies are such, which is basically allowing them to increase their ceilings, which is their debt ceiling. They have a particular ceiling, guys, where they cannot borrow more than that, but they are increasing that threshold on a yearly basis, and which is a big concern for us as a retail investors. So that's why this kind of fluctuation will remain as long as Trump is in the power, and he will flex his muscle. That we'll understand in the next report. So that's why it's always best in our interest to be invested for at least 25 to 30 years. So the $1 million question is, should we ditch S&P 500 in 2025? And the second important question is, does Donald Trump's move could bring extra revenue to USA, and would he be able to get better trade deals with China and other countries? In my opinion, no one could predict what will happen to the USA, S&P 500 or Trump economics. So looking at the recent trends, Trump might flex his muscles once again in the name of tariff, just to bring the recession in USA. Yes, guys. So this is going to happen today or tomorrow, and this is what the trends are saying, and not we are saying. And one more thing is, the market will remain volatile throughout 2025, 2026 and beyond. It is still early stage, and we should not forget that whenever USA had faced problems, they have always come out to be positive, and they have resolved the problems. In fact, they had very sluggish period back in 2002 as well as 2008. They had similar situations, but they've always come out to be positive. Not to forget that if USA sneezes, then everyone in the world catches cold. And that's why this article from JP Morgan is very interesting. What they are saying that a risk of global recession is looming, and there are 40% chances that we will have a global recession. So in 2025, the market will remain volatile, and that is certain because of these Trump's policies and also so many other factors. For those who are investing in USA indexes or UK indexes or even European indexes, this might, at least up to certain extent, it will reflect. So in 2025, if you want to know how you can create your own best 3 ETF portfolio for long-term investing, then you can watch this video now.